Well, today I'm going to take the session on the introduction to risk management and risk planning. Basically, before we undertake this session, at the very outset, we should know what is risk. We experience risk in our everyday life. Even if somebody is going in a train and we hear of train accidents, there is a risk in traveling in a train. We hear of air crash, there is a risk in traveling in an airplane. There is also a risk in solemnizing a marriage, in going in a marriage alliance, because you don't know how your partner will turn out to be. So there are various risks. There are risks in industries, there are risks in households, there are risks due to fire, there are risks due to burglary and theft. There are risks due to collisions, due to accidents. There are risks due to the changes in economy. There are risks due to unemployment. So how do we handle the risk? Do we have to insure all these risks? Do we have to do planning for all these risks? Do we have to manage all these risks? So we would be talking about these kind of planning, these kind of management. Management and planning is needed for all these kinds of risks. Basically, we are saying that there are three broad classifications of risks. Risk can be classified in three broad classifications. One of the classification is that risks. Basically, risk is the possibility of an adverse outcome out of an occurrence. When there is a possibility of an adverse outcome, I am talking about possibility of an adverse outcome. There could be an adverse outcome, there could not be an adverse outcome. That's why we are calling it as a risk. If we are sure that a loss is going to happen, if we are sure that an adverse outcome is going to happen, then it's not a risk, it's a certainty. So that means uncertainty is associated with risk. There has to be an uncertainty. That's why we call it as risk, because we don't know the outcome. So therefore, one of the broad classification of risk is that risk can be classified as dynamic risks and static risks. Dynamic risks are those risks which occur due to changes in the economic scenario of a nation. For example, changes in the price level, changes in the inflation rate, changes in the foreign exchange rates, changes in the government policy. So all these are dynamic risks, which also affects a large section of the society. For example, recently our rupee has got strengthened, so it has adversely affected some of the people like exporters. For example, some of my exporter has committed a price of say $5, and at that point of time, let's say that the dollar was worth 45 rupees. Let's say today the dollar's price is 40 rupees. So he would have kept a margin of say 4 rupees as per Indian currency. Now he would be losing the money rather, or he would be just making a break even. So that's dynamic risk point. Static risks are those risks where the risk is incurred in spite of no changes in the economy. For example, there is a fire, there is an accident. So in spite of the fact that there has been no change in the economic scenario of the nation, still we encounter certain risks. For example, an accident, a theft, a fire, the death of a person, which has nothing to do with the change in the economy. So that is known as a static risk. So this is one broad kind of classification. There is another broad kind of classification where we classify them as fundamental risks and particular risks. Now again, fundamental risks are those risks which affect society as a large group of people. For example, earthquakes, floods, hurricanes, natural calamities, such kind of perils, even unemployment. So these kind of risks, they affect a large section of the society, so they are known as fundamental risks. On the other hand, contrary to this, particular risks are those risks which doesn't affect a group as a whole, the society as a whole. It affects a person individually. As an individual, a person is affected. If a car of a person is stolen, then only that person is affected. The other persons are not affected. So that is a kind of a particular risk. A person's factory has been engulfed in fire, maybe due to any fortuitous cause. So that is a particular risk. Then there is another third way of classifying the risk. The third way is that we say that there are two kinds of risk. One is a pure risk and one is a speculative risk. So what is a pure risk and what is a speculative risk? Now pure risk is a situation where there can be two outcomes. Again, speculative is a condition where there can be two outcomes. In a pure risk, the two outcomes can be, one is loss. One possibility is that there can be a loss due to any circumstance. Whereas the second possibility is no loss. We'll dwell upon it later. Let's come to speculative risk. Speculative risk is a condition where there are two possibilities, either loss or profit. There can be another third possibility also, neither loss nor profit. For example, a person buying and selling shares. So either one can make a profit or one can make a loss or one can just break even. That is a situation of no profit and no loss. It could be in the shares market, it could be in any kind of business, it could be in any kind of situation. So these are known as speculative risk. Yeah, speculation differ from one business to another business. For example, if you are talking about a business, a person who is doing a business, who is setting up a factory, who is setting up a trading shop, so that is a business, that is entrepreneurship. A person is taking a risk over there, but that risk is a calculated risk. That is not a wild risk. He is doing all sorts of calculations that what would be the cost of the raw materials if I am working on it, then what would be the cost of the consumables and the cost of labor, the cost of machinery, the cost of electricity, and then and how much cost the finished product would be sold. So he has to basically make up projections for the next 3 years or 5 years. And if he's going to take a loan from a financial institution, he has to give all those projections, and he has to show that where he would be making his break even, on what kind of sales he would be making his break even. So these are the three possibilities. Whereas pure risk is a situation where either a person makes a loss or no loss. No loss means status quo. That person was where he was. For example, a person is having his car and he's driving it, and all of a sudden he comes to know that his car has been stolen, or his car has met with an accident. So that is the situation of loss for him. Otherwise he was happy in this condition, no loss. Now how to manage those risks? There are various ways in which the risks can be managed. Number one way is that risk can be avoided. We can avoid a risk. We know that certain locality is flooded, we decide not to go into that locality, not to take that risk. So that is one of the ways how to handle the risk. The second is risk can be retained. Okay, I know that, okay, we lose our pens, day in and day out. Sometimes maybe in a week we may lose one pen, or we may lose a handkerchief. We insure these items. Just for a momentarily moment, you can say we may feel bad about it. Maybe somebody has gifted that particular thing to us, but we don't mind because we can retain these risks. It doesn't affect us financially or economically. Then the third way to handle the risk, that risk can be transferred. Basically, this is what we would learn we would be talking about insurance. So insurance is a mechanism where we transfer the risks. And just to come to this point, insurance covers only pure risks. Pure risks come in the domain area of insurance. Insurance does not cover speculative risks because there is another condition, which is profit. If loss is going to happen to you, you would ask for a claim from the insurance company. But if you make a profit, would you give this money to the insurance company? No. So third way is risk can be transferred, and the fourth way is that risk can be shared. We would be talking about this in detail when we will be talking about insurance. There is another form of insurance which is known as co-insurance, where the risks are shared. Again, there is another concept which is known as reinsurance, where insurance company further insures its risk to another company. So this was an overview about risk management.
Sir, is risk assessable? If it is assessable, how we can assess it?
Yes, definitely the risk can be assessed. So again, there are various processes, there are various steps to manage the risk. First of all, the process is identification of the risk. First of all, one has to identify, for example, in a large industry, you have to identify which are the areas where risk can occur. Then again, management of the risk depends on the severity of the risk and the frequency of the risk. Maybe losing of a pen, the frequency of occurrence is more, but the severity of the loss is very less. So we won't insure it. But sometimes the frequency may be low, but the severity may be huge. For example, the whole factory, is engulfed in fire. So a person's, the lifelong earnings has gone. The person has become a pauper. A person comes to the street. So that's a big risk for him. So it depends on severity and the frequency of the occurrence. Sometimes it may happen that the frequency would also be more and the severity would also be more. So definitely, we have to then analyze it in that form, and then we have to assess what in terms of monetary figures, that what would be the amount of loss and what would be the amount of premiums that if we want to transfer this risk to an insurance company. So that is what about identification and analyzing the risk, and then assessment in terms of figures quantitatively.
Sir, can we overcome the risk through financial planning?
Yes, definitely. Financial planning, as the term is now understood, financial planning is now basically connotes also financial planning for individuals. Earlier, we used to consider any kind of any kind of planning, any kind of finance for business firms, business companies, corporates. But nowadays, financial planning has assumed importance in terms of individuals also. So an individual also is a family is also an industry nowadays, I would say. You have all kinds of gadgets, you've got all kinds of instruments. So you have to really manage, you have to you have to undertake maintenance, sometimes scheduled maintenance for your car, for your computer, for your microwave ovens and whatnot. So risk is associated with that also. So one has to take into consideration all those risks, and one has to plan for not only for the present but also for the future.
Sir, I just said that insurance risk can be transferred through insurance. Is it another way, any other way we can transfer the risk except insurance?
Insurance is the most methodical way to transfer the risk. Yes, in earlier times when insurance was not there, then people used to transfer their risks to banks, they used to transfer their risks to another business person. Nowadays also we transfer our risk to banks in the form of lockers. We keep our jewelry in the locker. So basically that is also transferring of our risks. We don't keep our valuables at our home. So that is another way of transferring the risk. Sometimes whenever we are going out to another city, so there is a cloakroom, since time memorial at the railway station. So we are just transferring our risk. We don't carry our risk. We deposit it in the cloakroom. In the hotel rooms, while we want to check out, but we have some other work to do. We have to catch a later night train. So we deposit our luggage with the reception. So that is basically a transfer of risk. So there are other informal ways also when an individual transfer his or her risks. We have instances when a family goes to attend a marriage session. So whatever the jewelry they carry, they hand it over to a responsible person in that family, so that they will wear it on the day of the reception. So in the meantime, so there are several ways of transferring the risk.
So how can one plan for the risks which are not determined beforehand?
See, nowadays it has become necessary to plan for the risks. So all the industries have been planning for their risks, and there are engineers, there are managers, there are risk managers now. And even the companies are employing their own risk managers. They are not just out relying on the insurance personnel, or they are not only relying on the brokers that they will tell them about the risk management. They are themselves undertaking all those kinds of maintenance procedures Earlier there used to be only breakdown maintenance, only when the machinery used to break down, then only they used to get it, set it right. Then there was a concept called scheduled maintenance. Okay, this machinery would be lubricated or this bearing would be set right, every week or every month. Now there is a concept called preventive maintenance, whereas they try not to create a situation in which such risks happens and the production comes to an halt and there is a loss of earnings, there is a the loss of labor also in that intervening period when the machinery is set right. So insurance, risk management and risk planning is very important these days. So similarly for an individual person also, we do not wait for the cloudy day. We have to plan it in advance.
So what kind of strategies can we use to reduce the risk?
As I had told you earlier, that there are various strategies in which risks can be managed. Basically, overall, they are all stating that how you can reduce your risk. For example, when I said risk can be retained, risk can be avoided. For example, if we want to reduce our risks, we install various kind of locks in our houses, various kind of internal locks in our houses, so that they are not easily. For example, I'll tell you very small example. When I had just passed my engineering, I was just 22, 23 years old then. I was living with my family. I had my parents, I had my grandparents, I had my two younger brothers. So my uncle was working as a branch manager in Oriental Insurance Company. So I had learnt about household insurance. So I also wanted to insure my house against the loss against burglary, theft, fire, etc. and then equipment's breakdown. So I went to my uncle. I said, "Sir, uncle, I want householder's policy." He said, "Oh, come on, you don't require it." I said, "Sir, you are the branch manager of the company and I am giving you business, and why you are refusing that you don't require a householder's policy?" He said, "See, you are living in the old city and it's in a densely populated area and yours is a joint family, and at any point of time your house is not locked, and moreover all your valuables and all are in the lockers. So I don't see much risk in your house. And at the most, and about that machine, television breakdown and refrigerator breakdown, and I think you can manage all those things. We were said to be a well-to-do family at that point of time." He said, "Well," so I didn't understand that concept. Basically, he meant that you can retain this risk. This risk can be retained.
While the planning word is used in all of the modules, the subject, but in risk management, why the word management is there? While in all other modules it's planning, like investment planning, insurance planning.
Basically, first of all, we have to manage. Management is basically, planning is part of the management. Management, in fact, starts with planning. First of all, you have to plan, then you have to organize, and then afterwards you have to implement it. So basically, planning is a subset of the management. Basically, mitigation is risk mitigation means how to avoid those risks, how to reduce those risks further, rather than rely on a third agency like insurance company or other things. Risk mitigation, for example, in an industry, you install proper pollution control equipments, you have proper guarding systems. For example, in earlier days, there used to be V-belts, connecting to one motor with a pump or other driver. So we used to place guards. So proper safety equipments and all are installed in order to mitigate those kind of risks. So risk mitigation, for example, there are proper fire sprinkler systems. For example, you have ensured that there is no inflammable material near a transformer in a factory. Similarly, in houses and housing colonies also, they are installed with all fire control systems, and insurance companies do give credit for that. They lower the premium for these kind of measures. So, because those kind of housing societies or those kind of industries, they have taken adequate measures in order to mitigate those risks. So, therefore, the risk has lessened. So, due credit is given to that. Thank you very much.